My name is Sherlock Holmes. It is my business to know what other people don't know.
Number 5. Why do companies indulge in financial shenanigans? Financial shenanigans are actions that intentionally distort a company's reported financial performance and financial condition. But before Brian learns how and where to detect such investing landmines, we shall discuss the underlying reasons of why companies choose to indulge in such activities. There are two primary ways that financial shenanigans distort the reporting of a company. First, to inflate current earnings by inflating current revenues or deflating current expenses. Second, and this may be a little bit more surprising, to deflate current earnings by deflating current revenues or inflating expenses. Let's start with the first one. There are plenty of reasons for managers to be interested in making profits in the current period appear like they are higher than they really are. For example, a company may soon go public. It could be in desperate need of a loan from a bank. The top executives may feel like their positions are threatened, etc. So it's quite clear why someone would want to show a better performance in a current period. The second group of financial shenanigans is a bit more confusing. Why would anyone be interested in showing a worse performance? For instance, a very strong company may want to create a reserve for a rainy day. This year, it may already have performed better than what the market expected. So, why not save some of the income and prepay some of the expenses so the company comes out on top again next year? Another reason may be because the company is about to be acquired, and the buying company wants the merger to look fruitful. This could be accomplished by holding back some of the income now and releasing it after the merger. A third reason could be because a sick company is taking a so-called big bath, reporting greater losses than justified to clean up in the balance sheet. This way, it can more easily look profitable again in the future. It's scary how companies can manipulate financial statements in both directions, depending on what they want to show investors. Warren Buffett compares this to shooting an arrow and then redrawing the bullseye exactly where it landed. It's very difficult to lose such a game. Number 4. The usual suspects.
By George, however did you see that?
Because, Dr. Carthew, I looked for it.
There are situations in which financial shenanigans are extra common, where there are greater incentives to fiddle with the numbers. Brian must now learn how to round up the usual suspects. Particularly, he should be careful with companies that 1. Are making lots of acquisitions, 2. Has dumb incentives for managers, 3. Are private, 4. Recently went public, 5. Recently changed business model, and 6. Has operational problems. Typically, a company that is making a lot of acquisitions, especially of weaker companies, could have something to hide. There's a very big difference between growth from acquisitions and organic growth from the core business, which I had to learn the hard way myself after a tough run in the Swedish betting company Betsson. Don't make my mistake. Be extra skeptical when you see this behavior. It's quite common for managers to receive bonuses if their unit or department performs well. If these bonus systems are formed in a clever way, they can create incentives that are favorable for the stock owners. However, if they are formed in a dumb way, they can be truly harmful. For example, many years ago, Heinz, the ketchup giant, had a bonus system based on net profits, but only up to a certain threshold. This made it so that the managers deflated earnings in the current period once this threshold was reached, fooling investors in the process. Private companies are often not required to issue audited financial statements, meaning that they haven't been checked upon by an outside certified public accountant. A company that is about to go public may be interested in inflating earnings, as typically many of the early shareholders will make exits. Changing business model is a red flag in itself, because it probably means that the core business of the company is no longer viable. Not only that, it also gives opportunities for manipulating previous accounting principles. Be extra skeptical if the business model changes from a simple one to one that is more difficult to understand. Operational problems is probably the biggest one though. We will learn how to identify these later in the video, but specifically, you should be extra careful when the growth of sales and profits are declining, there are large amounts of receivables or inventory to sales, and operating cash flow is slowing down in relation to earnings. Number 3. The 7 Shenanigans. If you feel like this takeaway is a bit difficult to understand, you may want to head over to my playlist of financial accounting books. Or you could just do that after this video to really cement your understanding of the financial statements. Anyways, here it goes. These are the 7 shenanigans that companies indulge in most frequently to fool investors. Recording revenues too soon or of questionable quality. A guiding principle here is that revenue should be recorded after the earnings process has been completed and an exchange has occurred. Companies disobey this principle when they, for instance, record revenue when there's still a lot more work to be done. Think of, for example, an IT company that has a 5-year contract of delivering a particular software, but decides to record the full 5-year revenue already in year 1. Recording bogus revenue. This is an aggregated version of the previous shenanigan. At times, companies just straight up decide to invent revenue out of thin air. A few of the tricks include recording sales when it's very doubtful that the customer is ever going to be able to pay, calling lending transactions revenue instead of debt, and recording rebates as operating income instead of a reduction in operating costs. Boosting income with one-time gains. Watch out for investment income, such as when a company sells shares in a subsidiary that is classified as revenue. Also, keep an eye open for reclassifications in the balance sheet. Shifting current expenses to a later or earlier period. An enterprise should capitalize costs incurred that produce a future benefit, and expense those that produce no such benefit. When companies invest in assets that are likely to be generating profits directly or indirectly over longer time periods, they are allowed to push such expenses to the balance sheet, instead of directly deducting them from the revenue in the current period. Then, costs can be spread out over the expected lifetime of that asset. That certainly seems fair, but it's very easy to fiddle with this. Either by capitalizing a cost that certainly should be identified as an operating one, or by writing down assets in the balance sheet too slowly. Failing to record or improperly reducing liabilities. An enterprise has incurred a liability if it is obligated to make future sacrifices. A great example would be an airline company that fails to record liabilities for frequent flyer bonuses every time a flight is purchased. Another more general one would be the company that is fiddling with accounting assumptions in the company's pension plans. Shifting current revenues to a later period. Revenue should be recorded in the period in which it is earned. If service is provided in the current period, it is improper to report the revenue in a later one. This one is fairly simple. Remember the example of Heinz previously? Creating reserves in the current period to be able to release them in a later one is one of the more common shenanigans among successful companies. And why do they do it? Because Wall Street loves companies that provide a smooth ride, and rewards these with higher trading multiples. Shifting future expenses to the current period as a special charge. Expenses should be charged in the period in which the benefit is received. Watch out for inflated numbers in the category special charges. Also, beware companies that are writing off costs associated with an acquisition too fast. Shenanigans rank from benign to outright fraud. Changes in accounting estimates in pension plans is quite like an orange flag. Capitalizing operating costs is more severe. And companies that are creating bogus revenues are the worst ones. Super red flag. Stay away. Number 2. Before looking at financial statements, consider this. Identifying these shenanigans can be done through a thorough investigation of a company's financial statements, but as this is quite time-consuming, Brian should make the process more efficient by first considering the auditor's report. This is the first go-to. The auditor has spent plenty of time examining the company's reporting. Don't waste your time by not using this resource. Look for the absence of opinion or of a qualified report. Also, think about the reputation of the auditor. The proxy statement. Look for management compensations and for related party transactions. Also, look for things such as lawsuits and other contingencies. Footnotes. Look for the accounting policies and be extra alert when you see changes in these from year to year. Also, search for long-term commitments that the company is making. One stock market analyst expressed himself like this about footnotes. They bury the bodies where the fewest people know how to find them, in the fine print. The President's Letter. What do we want?
Honesty.
When do we want it?
Right now.
When do we get it? Usually never. You should definitely read the comments that the CEO makes every year or so about his company. But you should also definitely take this with a grain of salt. A pilot wouldn't crash his own plane. An architect wouldn't admit a flawed design, and a CEO would never badmouth his own company. Watch out for the word challenging though, and any synonyms to it. It is a red flag. The MD&A. This is the management discussion and analysis found in the 10Ks and 10Qs. Beware when the management tries to twist unfavorable developments into favorable ones. Also, beware high management turnover. The Form 8K. A company must submit a Form 8K whenever there's a major event relevant to shareholders that has been happening. There are plenty of important ones, but for financial shenanigans, changes in auditors tops the list. Once you've read through this, consider calling one of these persons with concerns. The CFO, the head of investor relations, the corporate controller, or the treasurer. Often, this can help you to quickly gauge whether one of your assumptions are correct or not. If you are already a shareholder of the company, remember that these people are essentially working for you. Don't be afraid to pick up the phone and have a conversation with one of your own employees. And finally, number 1. Common size analysis. The common size analysis is a very useful technique for investigating a company's financial statements, not only from a shenanigans perspective, but also from a performance perspective. The tool can be used for cash flow statements too, but I think it's more useful and common for income statements and the balance sheet. Here, I will present the Swedish company H&M's last financial performance to illustrate the usefulness of common size analysis. You can find all of the data that I'm presenting here through SEC filings or similar, but it's much easier if you have access to a database. There are free services such as Saks and Yahoo Finance, or more advanced ones such as YChart and Capital IQ. Data used here is pulled from Yahoo Finance. Common size analysis can be used vertically, which means within a year, or horizontally, to express changes between years. Let's start with a vertical analysis. Here's what H&M's latest yearly performances look like. All these numbers may not say much at this point. When we do a vertical analysis, we express all the entries in the income statement as a percentage of the top line, the revenue, in each year. This reveals a whole lot more, especially if we compare it to numbers for the retail apparel industry in general. The industry data is gathered from Saks.com. For example, in its latest trailing 12 months, H&M had a net margin of 5.6%, compared to the industry average of 2.7%. I recommend finding the top 5 competitors of a company and then comparing the vertical analysis between these. Over to the balance sheet. Once again, it doesn't say much in its current form. However, if we do a vertical analysis, we'll express all the entries as a percentage of total assets. And now it gets much more interesting. For example, comparing the inventory and net receivable entries to that of the top 5 competitors could reveal a whole lot about the efficiency of the H&M business. Well, it's actually even better to compare net receivables and inventory to sales from the income statement, but this will do for now. Comparing total liabilities can reveal financial strength or weakness. Alright, back to the income statement to do the horizontal analysis. By keeping entries expressed as percentages of sales, we can see the year-to-year changes for profit margins. Unfortunately for H&M, this doesn't look good on neither gross, operating nor net levels. All the margins are deteriorating, and we should ask ourselves why this is happening before ever buying the stock. Moreover, we can see if the deterioration is just relative or, if it even worse, is happening in absolute numbers by expressing all the entries as percentages of the entries from 2016. This reveals that, at least, H&M is bringing in more gross profit than before. The operating income and net income are declining though. Finally, a horizontal analysis of the balance sheet should be done. Expressed in relative terms, we can see that the net receivables are growing. This is a bit worrisome. Is H&M being more generous towards its customers, offering better payment terms? Is this likely to have to continue? Is it a result of a declining interest in the company's products? Another red flag is that the total liabilities are growing quickly, and H&M's financial position is getting weaker. By expressing all entries as a percentage of the 2016 numbers, we can see if the results are also absolute. It actually reveals an even less appealing story. The net receivables have grown by 200%, and total liabilities by 100%. H&M may still be a great company to buy, but these factors should lower the price you're willing to pay for the stock. For financial shenanigans, be especially careful when the vertical or horizontal analysis reveals any of the 3 that you learned about in takeaway number 4.
Every problem is absurdly simple when it is explained to you.
Now, if you are interested in learning more about what the financial statements can reveal for you as an investor, head over to my playlist of books on that subject. This type of quantitative analysis is a very useful tool for any investor to have in his toolbox. Cheers, guys!